Okay. It is being recorded. Okay. All right. Let's focus on the subject at hand. So how to scalp the currency market every day like the dealer. I'm going to bring in my charts. Is Eurodollar chart? Very good. Does everybody see the Eurodollar chart? Just want to make sure everybody has a good view of what I have here. Yes? All right. So before we talk about the whole idea of scalping and how to scalp, let's try to understand the function of FX dealers in the currency market. I think there's a lot of misinformation and misunderstanding of exactly what the function of a dealer is. And I think there's a lot of animosity towards dealers that in many ways, some of it is deserved, but a lot of it is undeserved. Whenever you have a big financial market like the FX market, right, with lots and lots of different participants all across the world, that is open 24 hours a day, and that is available to everybody to come in and out of, enter and exit, transact at any given moment, at any given second, right? Whenever you have that kind of a market, right, in order to maintain an orderly market, in order to maintain a market where prices don't go from 136 to 136.25 to 136.50 in a gappy manner, you have to have somebody who's going to provide liquidity at every 1/10 of a pip along the way. And the reason why is because, let's say I want to sell euro right now at 36.20, right? In order for me to transact, Boyke, at the exact instant that I want to sell euro at 36.20, and he may actually be willing to do this, wants to buy the euro at 36.20. If he had done that, he would have been up already a pip, right? But the point is that in order for me to get done, somebody else at the exact same moment that I'm around must be willing to do my transaction. And you can see the logistical nightmare of that kind of a structure happening in a market that requires 1,000 transactions a minute from all across the world all the time. The imbalance between buyers and sellers logistically is usually imperfect. And in order to smooth out the pricing, you have a series of dealers, people who are willing to provide smooth and steady prices, to be on the opposite side of your trade continuously, in order for you to be able to transact continuously, right? The point being is that if there wasn't a professional person who was willing to take the other side of your bet 1,000, 10,000, sometimes even 100,000 times a day, it would be a very chaotic market. A market amongst amateurs is a market that just is very gappy and chaotic, simply because as a professional market maker, I have a huge amount of money, and I have a fully dedicated business, and I have complete and total support in order to be able to do one thing and one thing only, which is provide you with smooth and steady prices. But when you have a system of 1 million amateurs who only care about their very little slice. So, for example, I want to buy 10 million euros or sell 10 million euros, and Boyke is only good for 1 million. So what happens then? I got to go find 9 other guys to do business with at the same instant that I want to get it all done. You see how it gets very, very choppy, right? Now, one interesting thing that some of you who are maybe a little more sophisticated about markets can counter with me is say, well, Boris, that's the case in futures markets. You can trade S&P, you can trade euro futures, you can trade bond futures without the need of dealers. Why do you need dealers? All of those markets have every participant wired in, and everybody can make markets, and the ladder and the order book is completely transparent, and you can do as much or as little as you want given the order book. That's all very true. But what I think gets missed, and this is not an argument for a dealer-based market, because believe me, there's clearly a lot of flaws with a dealer-based market in the FX. But I think what gets completely underappreciated with futures markets in S&Ps, futures markets in Dow. And I'm actually curious, does anybody trade U.S. futures markets? Does anybody trade? Yeah. So, Forex Gal, Rob, Dr. Rob trades. So you're very familiar. E-mini S&P, right? E-mini S&P, fine, whatever. What many of you are probably unaware of is that a huge part of those bid and asks in the E-mini S&P is not just, random Borises or random, Dr. Robs trading amongst each other. The vast majority of those bids and asks are done by professional dealers who are simply putting in their orders in their order book. Groups like Citadel out of Chicago, which is a very big, large hedge fund, essentially has a massive business whose only job it is to make markets in the S&P 500 for the benefit of retail traders and institutional traders like you and I, who need instant execution, size, flexibility, and all those things in order to transact with the market. So that's the function of the dealer. The function of the dealer is to be able to provide you liquidity. It's an important function. It's a function that exists in dealer-based markets, over-the-counter markets like you have in FX, and in single book markets like you have in E-mini, S&P, Dow Jones, and all the futures markets where you have centralized book markets, right? The market makers present in every one of those venues, and they're all basically providing you liquidity, right? So if you think about the market maker, kind of like an insurance company, right? What does the insurance company do? The insurance company assumes a risk from you. You pay them a small amount of money, and in return, they're providing you liquidity. They're providing you the promise that that if you ever need to call in that insurance, they will pay out. They will pay out that insurance. And the market making model is very similar to the insurance model. The idea is I'm going to make a ton of small bets. And the majority of those bets are going to be working out for me. The market making model is basically high frequency, high probability, low profit model, right? Every single transaction, I'm going to make just a tiny little bit of money on. And there will be a few bad transactions where I'm going to lose a lot of money. So I'll make, 1 pip on 100 transactions, and I'll lose 50 pips on one transaction. And as long as I can maintain that, multiple of making lots and lots of little pips that overcome the one or two big large pip losses, I'm net positive. That is essentially the insurance company model. That is the market maker model. And it's all based, again, on a couple of very important risk and reward parameters. You take large risks, you get small rewards, and you look for very high frequency, and you look for high accuracy. And of course, if you have high accuracy and high frequency, what you're basically counting on is all those single pips adding up in aggregate to be more than occasional checks that you have to write for large losses, right? You with me? Somebody tell me yes, did you understand what I'm talking about? All right. So if that's the market maker model, right, is there a way for us to kind of quasi-emulate this thing? Rob says it's more like hedging. It's not like hedging. I don't want to get into a very, very complex discussion because I don't want to deviate off the subject. It's a broad general point. Hedging is, first of all, I don't even know what you mean by hedging. If you're talking about the kind of nonsense hedging that people do in the FX business, where they lock in losers by going on the opposite side of the market, that's not what dealers do. If you're talking about where they may sell you euros and then go out there and buy euro futures to offset the risk, to do a similar instrument the opposite direction, then that is hedging. And occasionally they'll do it, or they'll buy options against their position and stuff like that. Yes, but 99% of what dealers are doing is naked. They have a probability model. They have a statistical model. They're trading statistics. They basically believe that their win rate and their win per trade is greater than their loss rate and their loss per overall transaction, right? An insurance company will sometimes sell off its risk, but ultimately, the reason why insurance companies make money is because their businesses are based upon statistics. They know that if they sell 1,000 life insurance policies, 999 people are going to live that year, and one person is going to die. And if that one person gets $1 million payout, but 999 people paid them $1,000 that year, then they have, whatever, they paid them $1,500 that year. They have $1.5 million in revenue against $1 million payout. They're net positive $500,000. That's exactly what market makers do. The primary form of hedging is the law of large numbers, meaning they want to do a lot of transactions, and the statistical historical statistical rates at which they succeed. Now, can insurance companies go bankrupt? Of course. You could have a plague. You could have the Ebola virus. You could have a million things that are outside of their normal statistical models, right? And imagine an insurance company sells 100,000 life insurance policies to healthy 35-year-old people, and a massive bug from Asia hits New York City and kills 50,000 people that year. Will the insurance company go bankrupt? Absolutely, because they've collected $2 or $3 million in revenue, and they're going to have to pay out like $200 million in life premiums. So everything is everything is contingent on statistics, and statistics are by no means definitive. But that's basically how everybody does. You try to do the best you can, and you hope that history doesn't kill you. So, how do we scalp using these particular models? How do we apply a lot of these ideas into the trading during the day strategy that I want to show you? I'm showing you a very, very simple strategy. This is Eurodollar, Bollinger Bands. Let me make this the color black, right? So everybody can see this. Everybody sees the black color? Does it look good? Yeah. So Rob is saying to me, isn't that why we have reinsurers? Yes, we do have reinsurers, but remember, somebody is left holding the risk, right? And reinsurers are not going to buy all of your risk. They're going to just buy a part of your risk, right? And the point is that if Ebola virus hits New York City, doesn't matter who's holding the bag. Whoever is holding the bag is going to lose. This is the reason, by the way, where I just want you to understand, the market-making model works very, very profitably in normal markets. But there are plenty of market makers that can go bankrupt in extremely abnormal markets. And I'll show you examples of small-time abnormalities and how it can kill the whole process. So market making is based on the assumption of what's called reversion to the mean. Reversion to the mean basically means whatever happened is going to reverse itself. If there's an extreme move one way, it's going to reverse itself, right? And it's that assumption that prices are going to go the other way that provides me the confidence and the profit possibility in order for me to do the trade. So I want to show you a very, very simple idea of how we apply a market-making scalping model on a 5-minute chart, Eurodollar, and I'll show you a trade I just did on dollar yen as well, and the various parameters that I have working. So when we talk about statistics, we talk about the standard deviation distribution curve. I don't want to get too technical, but anybody who doesn't understand these basic concepts should read up. But if you're a trader and you don't understand the basic mathematics of how life works, how events work, how distributions work, you are really uneducated. You're not educated enough to want to be a trader. So I highly recommend you learn a little bit about statistics. You don't have to be a statistical genius, but you need to learn a little bit about statistics to understand it. So the basic distribution curve is a standard deviation curve, and Bollinger Bands incorporate that functionality right into the indicator. The bell curve, the market profile, the bell curve, right? Having said this, by the way, and I've said this yesterday, and I think it's important to qualify the statement. Normal statistics, normal distribution, generally, but by no means exactly fits the market. So a good example for you to understand how abnormal the financial markets are relative to the rest of life, right? If we were to measure every single human being in the world, some of them would be very tall, some of them would be very short, some of them would be very fat, some of them would be very skinny, right? And they would all fall into like a general 2 standard deviation bell curve. Now, amongst the whole population of human beings, no matter how different everybody is, we could never, ever find a person who is 25 meters high or 25 yards tall, nor could we find a person who weighs as much as an elephant does, right? So those possibilities are impossible in real life because normal humanity fits a normal distribution curve. However, the 25 meter, 25 yard tall person that weighs as much as an elephant or 5 elephants or a horde of elephants occurs in the stock market once a year. That's how freakish and that's how abnormal price action is. That's just to give you a wake-up call and to understand that everything that I'm doing here is by no means always going to work. In fact, not only will I can guarantee you that it's not always going to work, but I can guarantee you it will fail horrendously at certain points, precisely because of that massive incongruity of having a 25-foot high human being that weighs as much as 5 elephants happening all the time. So assuming we have normal markets, what are the kind of things that I like to do on a day-to-day basis? Here's the setup. I'll go through the rules, and then you guys can ask me questions, and then we can look at a couple more examples, and then we'll just discuss it in more detail. So the setup is this. First, and this is all New York time, right? So I'm looking at New York hours here. It's 2 o'clock in the morning, starting from 2 o'clock in the morning. I don't trade the setup. I only trade the setup from 2 o'clock in the morning until 2 o'clock in the afternoon New York time, which is 6 o'clock GMT to 6 p.m. GMT during the European and North American session, which is where it's most liquid. Can it be traded in Asia? Absolutely. Do I trade it there? I don't, because I think it's less accurate in that session, but by no means impossible. I think it's still very doable. So here's the setup as I do it, as I have it set up. What I'm looking for is on a 5-minute chart for the 5-minute candle to close above or below. In this case, I'm going to give you an example of a short. In this 5-minute candle, the closing, let me see if I can do display data. Yeah. So what you can see here is Bollinger Band up 36.15, and the closing value is 36.18. It's 3 pips above my closing value, above my Bollinger Band value, right? I would like to have two candles that close at least 2 pips above the Bollinger Band upper value. So in this case, I have that condition met at 36.17, right? And excuse me, the Bollinger Band is 17 and the close is 19, right? So I have 2 candles that have met the condition. That's condition number 1. Condition number 2 is I will add 10 points to the closing value In this case, the closing value is 19, which is probably around, it's 20 offer. It's going to be 20 offer, right? So because it's a 1 pip spread. By the way, I need to preface this by telling you, this strategy will only work if you have, if you're trading euro on 1 pip or better, pound on 1.5 pip or better, a yen on 1.5 pip or better. If you have a widespread broker, it's not going to work. So I'll tell you that up front. So anyways, my value here is 36.20 on the offer. I'm going to add 10 points to that, and I'm going to put in a sell order at 36.30 right over here. I'm going to offer out over here at 36.30, right? Two things are going to happen. Either price is going to rally to my sell point and get me done, or price is going to come back down and touch the 20 period SMA. If the price touches the SMA before I get done, my order gets canceled. The whole setup is invalidated. If it does get triggered, then I'm short at 36.30. My stop is 10 points. My stop is 10 points, and my target is 7 points. So I am minus 10 on the stop at 36.40, and I am plus 7, which is 23 right over here. I'll make this a little thicker. On my target. That's it. That's all I'm doing. It's a 7-10 proposition. If 2 out of 3 trades are positive, I'm net positive on the structure. Yes, I need a high win rate. Exactly. Just like a market maker. Market makers don't trade low win rates. They trade high win rates, right? Insurance companies don't trade low win rates. You know, insurance companies assume you're going to live, not you're going to die. They're not betting on you dying, right? So I'm not betting on being consistently wrong here. If I'm consistently wrong, the setup does not work. Absolutely. I don't understand what. Okay, so Mikul is asking me, what will my stop loss and take profit would be? My stop loss and profit right now is non-existent. I don't have a setup. Has the price moved above 2 standard deviations one way or the other way? No. So I don't have a setup. I'm telling you what setup occurred earlier today that I traded, right? So in this particular setup, I got short at 36.30. My target was 36.23. I got done. Here's another trade that I did on dollar yen, right? Dollar yen was a very, very good trade. Here's a good example where dollar yen is. Sorry, let me just. Okay, so in this particular case, dollar yen is about a pip and a half above the Bollinger Band. Price is 73, so 74 would be the offer. I put in a limit to get done at 84, right? It gets done. It actually goes to 84. I sold 84. I don't know why it's not showing it, but I did sell to 84. Oh, here's 84. Sorry, this is 84. So I got done at 84. My stop was 94. My target was 77. 77 just got done a few minutes ago, right? That's the setup. That's the setup in its simplicity and entry. The whole point here, the interesting little point that you need to understand is I'm not selling just when price starts to go above the deviation. I'm selling when the price extends, right? Because what I'm gambling on, what I'm betting on, is that if price does extend, it's going to reach a near-term saturation point. All the dealers have printed up all these offers. Everybody who wanted to be a buyer from 75 to 85 has gotten done. And now the dealers need to take back their trades. And everybody who got filled at 85 and 83 and 84, the dealers have filled them all the prices. And so they're now going to collect all that money back. And that's exactly what they're doing. And so that is what I'm betting on. I'm trading with the dealers. I don't look at the bias on any chart because this is not this is a statistical setup. I'm not even I in this particular setup I completely ignore news. I don't let my anything sway me because even in a news situation, you will often get these big spikes, right? Big spikes in prices, and then they'll come back down. As a matter of fact, we're talking about this in dollar CAD. I don't trade dollar CAD, but so here's dollar CAD. This is another good example. I don't think you actually did not have this the setup in dollar CAD. Excuse me, but it's a good example of how dealers take back their profits, right? So dollar CAD prices go well above 2 standard deviations. They extend over here, right? Dealers have printed up all these prices from 45 to 75. Now they take it all back, and they get it all back to around 35, right? Every price that they printed on the way up, they've collected back up, and now they let the prices go where they want to go. It's the support resistance trade in the most primitive sense of the word. I'm not looking for any support resistance on the chart. It's an imbalance trade. It's an imbalance trade, right? I'm looking for short-term, temporary imbalances in the order book, and I want to trade on the side of the dealers to see if I can correct those imbalances. So what's very, very important, by the way, and this is really, really important, why are the targets so short? Because if you have a very strong trend, if you have a big piece of news, if you don't take your money on a quick correction, you may have a big, big move up, big extension, and then you'll never get your money back. You'll just get stopped out. So it's one of those kind of things where you take your money quickly on any kind of a corrective move, because the corrective move is very likely to be very temporary. Occasionally, the corrective move can be very big, but a lot of times it can be very temporary. And the whole point here is to just, take your money, walk away, move on to the next setup. So Boyke wants me to do a buy setup. Let me see. I think, was there an Aussie buy setup? Let me see. Unfortunately, not here. I'm trying to see if I can find you a buy setup, but I can't get the because this got invalidated. Let me see. Maybe dollar yen earlier today. Let's see. So we had a dollar yen sell setup. So maybe this was, I don't know, where the hell am I? Did this work? Low 53. Oh, by the way, and here's a good example of like a fail trade. Now, this is obviously Asia session where I don't trade it, but it's a good example of like where prices basically do a walking the band move, right? You don't get any kind of a big bounce back. This is market makers have to face this all the time. So they print all these sell points, right? All these sell levels. So in this particular case, let's just say we know the setup is close 65, close here is 63. So we're going to be a buyer at 53, right? Maybe this actually would have worked actually. Here I'm a buyer at 53, right? So let's just say I'm actually a buyer. The setup actually would have worked. I'm a buyer at 53. My stop is 43. I think I actually survived the stop. Yeah. So everybody see this? See what I'm doing here? 2 candles outside of the Bollinger Band. The close here is 53. I'm buying at 43. Right. The trade is legitimate because the moving average has not been touched. I buy it over here in this final gasp of selling. I get done at 53. My stop is 43. My target is 60. So it takes a while. It takes about an hour for this thing to churn out. It goes down to as low as 49, but well within my stop. And then the 60 is pretty much hit over here, 60, 61. I'm down for +7. So that's a buy trade in the scalping setup. So somebody's asking me, where can we get 1 pip spread? There are lots of brokers that offer 1 to 1.5 pip spread. Let me just, I think maybe I was a little harsh. Basically, 1.5 pip spreads. I want to see euro dollar, dollar yen, pound dollar, Aussie dollar, 1.5 pip spreads or better. If you don't have that, then you have a problem. How many lots do I use? That's I won't answer that question because I really want to have that conversation for the next webinar. I will only tell you this. My trading results have, and I've written about this 1,000 times. I've written about this 1,000 times. You can read all of my columns. My trading results have improved 180 degrees ever since I started to trade unbelievably small instead of unbelievably large. I do a lot of trades every single day in very small amounts. And frankly, it doesn't matter what strategy you use. If you just do that, if you do a lot of trades in very small amounts, I am very confident that you will improve your results, even if you trade blindly. Less is equal to more, and more is equal to less. That's all very true. Do I trade London? At what time are my hours? I trade this from 2 a.m. to 2 p.m. New York time, which is 6 o'clock London to 6 p.m. London. Okay, so I traded New York, basically London to New York afternoon. I don't trade the market when the trade is between Bollinger Bands. Correct. What I'm looking for is extreme events. I'm looking for what's called a walk down Bollinger Band. In this particular case, we have a walk down Bollinger Band, and I'm able to get a good price. But occasionally, I mean, I think, here's a good. Let me find you examples of failures, because it's really important to look at failures. Let's look at cable. There was some massive failures here that. Not yesterday, but yeah, okay. This is a good example of failure. Okay. So you see this? This is what's known as a market maker nightmare. This is essentially a one-way market. Everybody just decides to sell. There's absolutely no buyers. There's no reprieve. Everybody sells. They take a pause and they sell some more. So I bought this from them. I have no chance to get out of my trades, and now they stuff me with more trades, and they bring me down, right? And that's why it's very, very important to have stops. This is really, really important that, when you're losing, you only want to lose 10. Because if you do a very, very stupid thing, which is that you buy here, you average down a little bit more, what you're doing is you're winding up effectively destroying yourself. This is not going to turn in your way. This is only going to bankrupt you, because this is a one-way market. And your whole point is that these kind of one-way markets happen 1 out of 10 days. When you have this 1 out of 10 day event, you just want to lose money and walk away. Just like a guy who dies in an insurance company. You don't sit there and you say, hey, if you pay us more premium, we'll double your life payout, right? It's actually a good example, right? Insurance companies don't ever say, you know what? We won't pay you $1 million, but if you pay us a premium and die again, we'll pay you $2 million. But that's exactly what you're doing when you're averaging down. You're basically being that kind of a stupid fool when you're trading on an average down position. What helps you recognize this kind of a strong trend? Being stopped out, Robert. A stop is a really good recognition that you're in a strong trend. That's what makes you losing money makes you recognize that you're in a strong trend. You're not going to avoid getting in. Insurance companies don't you don't know ahead of time who's going to die, right? You try to make the best possible effort by choosing a good time, a good strategy, and a good money management technique. But you don't know who's going to die, who's not. So no running away from losses. If you didn't assume risk, you wouldn't have reward, right? So I know we all want to have a strategy where we have 0 losses, but that's not going to happen. Are there ways to minimize your losses? Absolutely. We can talk about that, next couple of sessions that we have. But in this strategy, the risk is very controlled, right? Okay, Kawash wants one more example. For those of you who are late, are there any? Guys, Draghi ECB. I will write about it on my on bksmanagement.com. There's nothing that more I can tell you. Okay, anything I tell you is actually completely and totally immaterial. I know as much as you do. He's going to probably cut rates. He may do QE. A euro may go down to 135. So there. Is that a strategy for a trade? I don't think so. And it's worth about as much as what I just told you. What is the win percent on this thing on a back test? 0, because that's another pet peeve of mine. If back tests work, then every back test strategy would make you money. How many back tested strategies make you money? Exactly. Right? You know why back tests don't work? Because they test the back. You know why strategies have to work? Because they have to work in the front. Think about that for a while. It works in the front. So far, so good. That's all you can take out of the strategy. By the way, just one last riff on the whole back testing. Andrew Lo is an MIT finance professor. He's probably the most famous professor of quantitative analysis in the world. He created this incredibly interesting mutual fund full of his back-tested quantitative techniques. This guy's mathematics is by an order of magnitude 1,000 times better than mine. Guess what the return on his fund has been over the last 3 years? He has managed to lose money every single year for the last 4 years. Good markets, bad markets, in-between markets, with remarkable consistency, right? You think the guy back-tested every one of his strategies about 1 million times? You think he had incredible statistical confidence in how well his strategies would work? That should tell you everything you need to know about the value of a back test. A piece of toilet paper is more valuable to you than a back test. Great question. How to use the strategy during news events? Generally, remember, it's a good question, actually. Excellent question. It's a good caveat. Generally, remember, I'm trading this usually behind the news, right? Because it's usually a reaction to the news, or sometimes it's a little bit ahead of the news. If I'm floating a trade and there's a news event in front of me, I'll close the trade out. Because remember, this is a controlled risk trade. You only want to control 10 points of risk. If you have a news event, you could lose 50 points on a news event. So I want to have a controlled risk trade. Yeah, you definitely want to trade behind news or close them out in front of news. Good point. Yeah, mostly market is between Bollinger Bands, so you stay out of the market when until you see the trade move around. I'm going to repeat this setup. I know there's some late people here. Let me just find you a setup in the pound. Okay, I think this is a setup in the pound that we could probably worked. Yeah. Okay. So here's the setup in the pound. So what we're looking for in this particular case, right? Price level candle closes below the two standard deviation Bollinger Band once and twice, right? No, in this case, this one actually, this is a failure. This is a good example of a failure. But then I think I think this one was. No, this one is not tradable. I can't find the right pound. Pound here is a failure actually. So you know the close here is 17, right? I'm going to be a buyer at 67.07, right over here, with a stop at 97. And I would get stopped out right over here, right? It actually went down -20, and it would have stopped me out. So let me find you an example where, so you're -10 on this particular trade. Let me find you a pound where it would have worked. I can't find it. There are no good setups right now that I can seem to find. Because all of these would be validated. Let's see if we can find it on Aussie, because I know you guys have. Okay, so maybe I think this is a good example. So, and remember, it's got to be two consecutive. The other point is that it's got to be two consecutives outside. So these don't count. These two would count. So this is 93.13. It closed 93.13. Two candles outside of the Bollinger Band. I'm going to subtract 10 to be a buyer. 93.03. 93.03. I'm a buyer over here. Right over here. It goes all the way down to a 92.99. My stop will be 92.93. So I survived the stop. And 93.10, right back up, I make money. Okay? So yeah, Rob is wisely saying that he doesn't want to get into a religious argument with me about backtest. What's the forward test so far? Forward test has been running about 70%, right? And Rob, it's a very small sample. I'll be the first one to admit that it's a pretty small sample so far. Catch me next month. When I'm hoping to. I do about 2 or 3 of these a day. Well, hang on. Let me just tell you the sample size this week, right? Because I have it on my other computer. So we have. Yeah. Okay. So, I mean, and this is very non-representative. So it's only so far. Like I think 9 trades, 8 accurate, 1 miss. That's a very, very high percentage. It's very skewed. So 8 divided by 9, it's about 85%. Let's just put it this way: if I have 100 trades and I can do 70%, then I'm doing very well. That's really what I'm shooting for. I'm looking for 100. I'll have a density of about 100 trades by next time we get together next month, and I can report the results to you. That makes sense? Okay. Final questions, guys. Anybody have any final questions for me? I will be in Forex Day in Madrid. That's right. Absolutely. For those of you who are going to come to Madrid, and those of you who are going to be in Spain, I will be there June 14th. Couple of weeks. Can't wait. Should be a lot of fun. Have I tried to increase the pip profit? Here's the point, Robert. Remember, this is a risk mean reversion trade. Mean reversion trades, by definition, are going to disappear. The profits are going to disappear, right? You're going against the prevailing trend, so your corrective phase is going to be very short-lived. You take them where you get them, right? As a matter of fact, I take a few of them at +6 to get out. My general attitude towards trading is I would rather have a ton of scratches or small trades and be much closer to 80% than to have a few big winners and be closer to 60%, right? Again, I'm trying to trade like an insurance company, right? I'd rather do a lot of transactions and make a little bit of money on each little transaction and try to avoid as many big losses as possible rather than try to go for the big wins. That's right. We make it up on volume. Potential setup in pound dollar on the 1 minute. I don't trade 1 minute, Richard. So 1 minute is like an intense strategy, but I trade the 5 minute chart. 1 minute could, it's a whole different ball game, but it could be interesting. I should manage McDonald's. Not a bad business, although I absolutely hate the food. I'm an extremely good gourmet cook, so I would never manage a McDonald's. Cooking is my one other passion besides trading. What else? So the premise is on a 5-minute chart, the market will stretch about 10 pips beyond the standard deviation and retrace about 7 pips. That's the premise, Rob, right? And Rob, I'll be the first one to admit to you that that's the rough premise, and it's a premise that applies pretty much to the most liquid, tightest pairs. So you're certainly not going to use that premise on a pound yen. You're not going to use the premise on a pound Aussie. And you probably want to have a dynamic premise rather than a static premise. But, I'm trying to make simplicity here, not get too complicated. I'd rather be generally right than precisely wrong. Pound dollar setup on 5 minutes. Let's take a look at Richard's telling me there's a potential pound dollar setup. So let's just take a look. Yeah, so the pound, that's a good example. Right. The pound is actually did set up, right? So pound is above here. And then above here, the close here is what? 70. So we're going to lay out orders at 80. If the order gets hit at 80 before it hits the moving average, the 20-period moving average, then we're going to be in the trade, and we're going to manage it out for 73 target, 90 stop. So let's see if it works. Right. Yeah, and you remember, Rob, the one-sided days. I'm trying to spread my my sample size across currency pairs too, right? So you may have a one-sided day in the pound, but you could have nice profitability in the euro that could potentially offset some of the losses you have in a pound, that kind of stuff. So the primary pairs I trade is pound, Aussie, euro. But you could probably, and I just traded dollar yen this morning. You could definitely weave in dollar yen right now. But it's all about doing lots and lots of trades. Well, I want to do in a perfect world, I want to do 100 trades a week on this. But in order to do that, I got to do that on a algorithmic basis. I can't do this on a manual basis. Right now, I'm doing it on a manual basis because I'm basically testing out a lot of different components. But ultimately, it's got to be done on an automated basis. So it looks like pound is starting to rip a little bit here, and we may be able to get 80. Let's see if we can get 80 on the thing. I'm actually gonna lay out the order while I talk to you guys just to see if it floats. All right, I put the order out right now. Okay, guys, I thank you. I hope you guys all have fun. What will be a stop loss for 80? It'll be 90. So my order now is sell at 80, stop loss 90, target 73. If it hits the 20-period moving average, I'm going to cancel the order. So if it corrects to the 20-period moving average before it executes my sell, I'll cancel it. I'll be honest with you, I'll cancel it in about an hour and a half anyways, because it's Friday. Do I using SMAs? I'm using SMAs, not EMAs. SMAs. It's standard setup. Standard setup. Okay, I think we ran out of time. I thank you very much, guys. A lot of fun. Hope you guys enjoyed it. We are going to record this, so when we get the recording link, I'll put it up on my Twitter, and everybody can watch it again. Everybody have a great weekend, and enjoy trading. And the stop loss is 10. The take profit is -7. Okay. Okay. Awesome, guys. Everybody have a great weekend. I will see you. I will see you next month. We'll do a little bit of P&L at that point. Talk to you later. Bye bye.